Okay, so have you ever heard of stocks that are so darn reliable they're basically royalty? That's what we're talking about today. We're going to dive into this super exclusive club called the Dividend Kings. These are companies with a track record that's frankly kind of hard to believe, paying their investors more and more year in and year out. Let me just start by asking you this. What if your investments could give you a raise? Not just, once, but every single year for 50 years straight. I mean, it sounds crazy, right? Almost impossible. But it is the reality for this elite club of stocks we're about to get into. So how in the world is a 50-year raise even possible? Well, it all boils down to one of the most powerful, fundamental ideas in all of investing, the dividend. All right, so what is a dividend, really? The simplest way to think about it is like a thank you from a company you own a piece of. But, instead of a card, they send you cold, hard cash. It's your slice of their profits, paid right into your account. And here's the key thing. Stock prices go up and down, right? But once that dividend cash hits your account, it's yours. It's a real, tangible return on your investment. Now, once you get that dividend cash, you've got a choice. You can spend it, right? And hey, that's not bad. After 5 years, you'd have an extra 50 quid in your pocket, and you'd still have your original 100. But here's where the magic happens. You could reinvest it. And when you do that, something incredible starts to happen. You start earning dividends on your dividends. Look at the difference. After 5 years, your total pot is bigger, sure, but the income it's throwing off every year is also growing. That is the power of compounding. And this isn't some small thing. The power of compounding is so huge that Albert Einstein himself supposedly called it the eighth wonder of the world. It's that simple idea, earning returns on your returns. And that's the engine that can take a tiny stream of payments and turn it into serious wealth over the long haul. So this idea of consistent, reliable growth, it's the signature move of a very, very special group of companies. I mean, they've been doing it for so long. They've created this super elite club of consistency. And now it's time to meet them, the Dividend Kings. Okay, so before we get to the Kings, you've probably heard of the dividend aristocrats, right? And don't get me wrong, these guys are impressive. They're S&P 500 companies that have hiked their dividend for 25 years in a row. That's a fantastic achievement, no question. But the Dividend Kings? Phew. They are on a whole other level. To earn this crown, a company has to raise its dividend for 50 consecutive years. I mean, 25 years is a marathon. 50 years, that's an ultra-marathon of just pure financial consistency. I mean, just take a look at some of these streaks. It's incredible. American States Water is at 71 years. Procter & Gamble, a name we all know, 69 years. Coca-Cola, 63 years. To put that in perspective, these companies have been giving their shareholders a raise every single year since before we even landed on the moon. Think about that. So what kind of company can actually pull this off? What do these businesses even look like? Let's go take a look inside the kingdom. And if you look at where these kings come from, a pretty clear picture emerges. You've got industrials, consumer goods. They make up well over half the list. Utilities are a big chunk too. What you're not seeing here are a bunch of flashy, high-flying tech startups. Nope. These are, for the most part, super stable, established companies that make the stuff we all use pretty much every single day. And these companies, they all tend to share some very important DNA. They have what smart investors call a moat, like a castle moat. It's a powerful, durable advantage that keeps competitors at bay. Maybe it's a famous brand, maybe it's some unique patent. They also have a track record of smart management that actually cares about giving money back to shareholders, and they've proven time and time again that they can survive anything the world throws at them. Recessions, wars, you name it. Okay, but it's not all a fairy tale. Even in this kingdom, crowns can be lost, royalty can be overthrown. This is absolutely not a buy it and forget it kind of deal, and you really, really need to understand the risks involved. And this leads to one of the biggest warnings for any dividend investor. A super high dividend can sometimes be fool's gold. Yeah, it looks all shiny and tempting on the surface, but it could be hiding some really deep problems just underneath. This is what we call a yield trap, and here's how it works. The dividend yield is just a simple math problem, the annual dividend payment divided by the stock's price. So what happens if the company gets into trouble and its stock price tanks? Well, the math says the yield percentage suddenly shoots way up. It looks super attractive, right? But more often than not, that crazy high number is just a giant flashing red light warning you that a dividend cut might be just around the corner. And believe me, this isn't just a textbook theory. This happens in the real world. Just look at what happened in 2024. Leggett & Platt, poof, a 52-year streak gone. 3M, a household name, ended its run of more than 60 years because of massive lawsuits and some bad business deals. It's a tough reminder that even kings can lose their crowns. And that old saying is true. Past performance is absolutely no guarantee of future results. Okay, so with all that in mind, how do you tell the strong kings from the ones that are about to stumble? Well, let's put together a little toolkit for you. A few key things to look at that will help you see past the shiny crown. All right, we already talked about the dividend yield. Think of that as your return. But you can't look at it alone. You have to pair it with its partner, the payout ratio. And this is your sustainability check. All it's asking is, what percentage of the company's profits are they using to pay this dividend? And if that number starts creeping up, and especially if it goes over 100%, well, that's a huge red flag. It means they're paying out more money than they're making. And just like with your own budget, that is simply not sustainable. So here's a really practical checklist you can use, kind of a mashup of what the pros look for and what you see in savvy investor communities online. You're basically just running down a list of simple questions. Does it have a solid, consistent history? Is that payout ratio in a safe zone, say under 80%? Is the company's balance sheet healthy? Is it actually profitable, and are those profits growing? And last but not least, is the stock itself a good deal right now? If you can tick all or at least most of these boxes, you're off to a really good start. Hey, remember that compounding magic we talked about at the very beginning? Well, there's actually a way to put that whole process on autopilot. It's called a DRIP. That stands for Dividend Reinvestment Plan. All it does is automatically take the dividends you receive and use them to buy more shares of that same stock, a lot of times with no fees. It is the ultimate set it and forget it tool for really getting that compounding engine roaring. All right, one last thing, and this is super important. Taxes. Just a quick heads up. Even when you're using a DRIP and you never actually see the cash in your hand, those reinvested dividends are usually still considered income, and you'll likely have to pay tax on them that year. So just make sure you look into the specific tax rules where you live because it can get a little tricky. Which brings us all the way back to the big question. Are Dividend Kings the secret to building long-term wealth and a reliable income? Well, they offer this incredible history of stability and growth for sure. But as we've seen, even the mightiest kings can fall. So I think the real takeaway here isn't to just blindly buy a stock because it has this fancy title. Instead, use it as a starting point, a fantastic list of companies to research. Look for those hallmarks of a true king, the resilience, the smart decisions, the sustainable payouts, and no matter what you end up investing in, you'll be a much, much smarter investor.